Good day to everyone. Thank you for joining me. I am Zintle Mayegiso and I am going to take you through a summary of our recently published Sasol report. In our view, Sasol has increasingly transformed into a chemicals company. About 57% of Sasol's revenue is attributable to its chemicals business. The performance of this business segment has become gradually more important given management strategy and focus on the chemicals segment. Sasol's operational performance is mostly driven by commodity prices. The group's energy business is driven by the Brent crude oil price and the South African currency, while its chemicals business is driven by low feedstock costs and higher chemical product prices. Sasol is currently trading at a forward PE of 8 times, which is below its historical 10-year average of 9.5 times. We believe the market is starting to factor in Sasol's deteriorating balance sheet and weak fundamentals faced by its chemicals business. Sasol's proposition for its chemicals business is to convert low-priced ethane gas into high-value chemical products. Sasol's chemicals business is currently facing a bearish chemical cycle, which has been driven by declining prices within its high-margin chemical products, as well as potential increases in the ethane price, driven by increased demand for new ethane crackers coming online. Sasol is currently facing an increased risk profile through the decline in chemical product prices, a severely constrained balance sheet, and slowing global economic backdrop. The group's chemicals business is also facing growing competition from additional ethylene capacity and supply into the market. The surge in supply threatens future margin upside, considering a weak economic growth environment that affects demand growth negatively. We see the potential for further derating if protracted deteriorating fundamentals affecting the chemicals business continue for the medium to long term, even with a recovering oil price. Sasol's balance sheet remains severely constrained. We expect net debt to EBITDA to remain elevated into 2021 and expect it to remain sensitive to any mismatch between LCCP ramp-up costs and revenue. We note Sasol's recent trading statement on the 25th of November, in which they announced that they've secured a syndicated loan worth $1,250 million. Sasol also announced that its lenders have agreed to increase their net debt to EBITDA ratio covenant from 3 times to 3.5 times for the reporting periods December 2019 and June 2020. This is positive in the near term as it minimizes the risk of breach of covenants and potential risk of a capital raise. The loan offers Sasol flexibility and liquidity within its U.S. operations and minimizes balance sheet risk in the near term. Net debt to EBITDA ratio covenant reverts back to 3 times after June 2020. We believe that any delays in LCCP are likely to be a headwind that could impact Sasol's deleveraging efforts, which could result in higher financing costs and increased balance sheet constraints. To conclude, we have downgraded Sasol from our previous neutral recommendation to underweight, given our bearish stance on petrochemicals, high financial gearing, and risk profile Sasol is facing. We therefore recommend an underweight exposure relative to the capped SWIX index and maintain our view that the investment proposition remains primarily hinged on the success of LCCP, positive Brent crude oil price, and chemical pricing outlook, as well as Sasol's ability to maintain low financial gearing levels below covenants in a sustainable manner. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. A comprehensive investment idea on Sasol can be found on the PSG online trading platform. Before we end off, please take note of the disclaimer. Thank you.